Okay, let's dive right into this explainer. Picture this scenario, right? It's a random Tuesday, and you realize you finally have exactly $100 just sitting in your account. Maybe you sold some old clothes online, or I don't know, you finally cashed a birthday check you totally forgot about. Whatever it is, you don't need it for rent, you don't need it for groceries, and your phone bill is completely paid. You're thinking to yourself, all right, this is it. This is my investing era. So what do you actually do? Well, you open up social media and bam, immediately, you are just bombarded.
You see these wild claims literally everywhere. Gurus yelling about penny stocks that are supposedly guaranteed to be the next Amazon, or influencers pushing you to buy some specific crypto token before it explodes to the moon. And you're probably just sitting there completely overwhelmed, thinking, look, I just want to do this the smart way without literally lighting my money on fire. And hey, your anxiety here, completely validated. The absolute truth is, $100 is plenty of money to start with, but it's also the exact amount people blow by chasing these chaotic shortcuts. And the real tragedy? When beginners lose their first $100 this way, they don't just lose the cash, they lose the confidence and the momentum to ever keep going.
So that brings us to the core purpose of today's explainer. How do you actually put that money to work without it going up in smoke? Well, we need to fundamentally shift your mindset. Your first $100 isn't about picking winners. It is not a lottery ticket. It's entirely about building a bulletproof, automated system. We're going to use the three-bucket investment framework to turn you into someone who invests consistently, logically, and calmly.
And this brilliantly illustrates exactly why this mindset shift is absolutely crucial. Consider these numbers from Dalbar covering 2024. The S&P 500 returned over 25%, which is huge. But the average equity investor, they only saw a 16.5% return. That massive gap isn't because everyday investors lack intelligence or don't know how to read a spreadsheet. It's entirely about behavior. Things like fear, excitement, ego, and just pure impatience cause beginners to buy and sell at the exact wrong times. Seriously, behavior, not brain power, is what destroys beginner returns.
This means before we can even talk about buying a stock, we have to ask one critical step zero question. If an unexpected expense pops up, will you need this money back immediately? The Federal Reserve actually found that a staggering 18% of adults said the largest emergency expense they could handle was under $100. Let that sink in for a second. If a surprise bill hits and forces you to sell your brand new investment at the worst possible moment just to keep the lights on, well, investing didn't actually help you. It actively hurt you.
All right, let's get into the three-bucket framework, building a bulletproof system for your money.
That harsh reality leads us perfectly into the paradigm-shifting strategy we're breaking down today. To build this bulletproof system, I want you to think of your $100 as having three possible destinations. Our very first destination is bucket one, safety. If you currently have zero emergency savings, the absolute smartest first move you can make is putting that $100 straight into a high-yield savings account. Now, I know exactly what you're thinking. That doesn't feel like investing. It feels boring. But it absolutely is investing. By creating a cash buffer, you are literally investing in your own ability to stay invested later on.
Now, what's really interesting about this concept is the psychology behind why bucket one is mandatory. It comes down to a deeply ingrained psychological quirk called loss aversion. Basically, human beings feel losses much more intensely than we feel gains. When financial stress hits, say your car suddenly breaks down or your furnace gives out, your brain doesn't calmly sit there analyzing 30-year market returns. Nope, it screams, I need cash right now. This brain trap forces beginners to panic sell their investments at a steep loss. Having a simple safety bucket acts like a financial shock absorber to completely neutralize that panic.
Okay, so once you have that safety buffer in place, we move on to bucket two, high-interest debt. Listen, if you are carrying credit card debt, you have a leaky bucket. Trying to build wealth while carrying high-interest debt is literally like trying to fill a bucket that currently has a massive hole in the bottom. The water is pouring out way faster than you could ever pour it in. It simply doesn't work.
Let's just look at the sheer, undeniable logic of this. If your credit card charges you 25% interest, paying off that balance is the mathematical equivalent of earning a guaranteed 25% return on your money. And let me tell you, the stock market does not guarantee anything close to that. Zero chance. So if you have this kind of debt, your first $100 goes right here. Not because the stock market is bad, but because patching the hole in your bucket is mathematically vastly superior to betting on completely unpredictable market returns.
Let's move to and see how this builds into our final destination, bucket three, actual investing. Assuming you've got a small cash buffer, you don't have any urgent high-interest debt, and you can truly leave this $100 alone, now we invest it. And I'm going to be really blunt here. This money should absolutely not go into meme coins, individual stocks, or penny stocks. You might hear a crazy story about a guy who turned $100 into 50 grand on some dog-themed coin, but what you never hear about are the hundreds of thousands of people who lost everything chasing that exact same high. Could you get lucky? Sure, maybe. But that's lottery behavior, guys. That's not investing.
The truly smart approach is actually wonderfully simple. Just buy the entire market at a low cost using a broad index fund. Why? Because over long periods, the vast majority of professional active managers heavily underperform broad market indexes. Think about it. If the highly paid professionals working on Wall Street, whose entire full-time job is to pick winning stocks, struggle to consistently beat the market, a beginner isn't going to consistently pull it off with a random $100 trade on their phone. So save yourself the stress and just own the whole market.
Which brings us to our next section, the actionable steps. How to actually invest that $100.
All right, so we have the theoretical framework of the 3 buckets down. Now let's shift our focus to the literal execution. How do you physically put that money into bucket 3? Here are your 4 exact steps. First up, choose the account. You want to look for the lowest fee and most tax-efficient account available to you. For example, if your employer offers a 401k match, that is literally free money, definitely start there. Or look into a tax-advantaged account like a Roth IRA. Second, choose just one diversified index fund. You really don't need a complicated portfolio. Look for a total stock market fund, an S&P 500 fund, or a target date fund, which conveniently automatically adjusts its risk profile as you get older. Third, physically invest the $100. And hey, don't worry if a full share of the fund you want costs more than $100. A lot of brokerages now let you buy fractional shares, meaning you can buy exactly $100 worth of something that costs, say, $400 a share. It makes this totally possible. Finally, step 4, automate the next contribution. Go ahead, log into your account settings and set it up so money transfers automatically every week or month. This last step right here, this is the real, unglamorous secret to building wealth.
So the crucial point is the historical math behind this. Historically, long-term real returns in the US market after inflation sit right around 6 to 7%. If you invest your $100 just once and literally never add another dime, at 7% growth over 30 years, it turns into about $760. Nice, but not exactly life-changing money, right? But think about the alternative. If you build the habit and automate just $25 a week for 30 years at that same 7%, you end up with roughly $120,000. Think about that. You didn't need to be a Wall Street genius to get that $120,000. You didn't need to time the market perfectly. You just needed the boring consistency of automation, because automation beats motivation every single time.
Now, as you pick your fund, you have to watch out for the silent killer, fees. I know, fees are boring, which is exactly why they are so incredibly dangerous to your wealth. Actively managed funds often charge around 1% per year just for the privilege of letting them handle your money. Meanwhile, many broad index funds charge a tiny fraction of that, around 0.05%.
I know that difference between 1% and 0.05% looks incredibly small on paper, but over decades, it compounds massively. A low-fee fund can actually end up being over 30% larger than a high-fee fund over long investment horizons, simply because you aren't bleeding out money every single year. You are literally keeping thousands, sometimes tens of thousands of dollars in your own pocket just by paying a little attention to the fees when you set this up. This cements exactly why low-cost index funds are the absolute smartest place for a beginner to start filling bucket 3.
Moving on to our final section, beating your own brain, why everyone doesn't just do this.
Let's step back for a second and be real. If the math is this simple, and if the steps are this incredibly clear, why doesn't everyone just do this? Well, the harsh reality is that execution is hard, simply because your own brain constantly works against you. See, your brain naturally craves excitement, and putting money into broad index funds month after month feels, well, incredibly boring, whereas day trading feels thrilling. Your brain wants a sense of control, which makes trying to pick individual winning stocks super tempting, while simply buying the whole market feels sort of passive and lazy. But ironically, doing less, keeping it boring, keeping it consistent, is actually the most successful long-term winning strategy, completely despite what our ego desperately wants us to believe.
Look, most people never invest their first $100, not because they can't, but because they keep waiting for the perfect time. They wait for the market to dip, or for their next big promotion, or for some magical sign that they suddenly know enough. But people who build actual wealth don't rely on perfect timing, they rely on better systems. So I am leaving you with a challenge straight from our source material today. In the next 24 hours, take action. Seriously, don't wait. Put $100 into an emergency buffer, pay down that high-interest credit card debt, or invest it into a broad index fund and automate your next contribution. Which bucket are you filling right now? Because if you build this system today, one day you're going to look up and realize something totally surprising. The money isn't the biggest thing that changed.
You are.